Welcome to Skytech-Lens. The summer of 2025 shattered North America's trade consensus. President Trump's administration doubled tariffs on imported steel and aluminum to 50%, then slapped a 35% tariff on Canadian exports, citing fentanyl trafficking, a claim Canada's Prime Minister Mark Carney called economic warfare. Markets panicked. U.S. steelmakers like Nucor hiked prices by $150 per ton, sending costs soaring for manufacturers. The S&P 500 dipped, and Wall Street dubbed it Trump's metal recession. Michigan's unemployment rate spiked to 5.4%, the highest in the nation, as the auto sector faltered. The cross-border supply chain, once seamless, was thrown into chaos. Instead of protecting American jobs, the tariffs triggered layoffs and uncertainty. The 12 million tons of Canadian steel that fueled U.S. industry became collateral damage. The policy ignored the reality of modern manufacturing, where products cross borders multiple times before completion. Rather than strength, the tariffs brought disruption, uncertainty, and a new era of confrontation. Canada, led by Mark Carney, refused to retaliate blindly. Within 48 hours, Ottawa launched a $1 billion initiative to decarbonize its steel industry, accelerating the shift to electric and hydrogen-powered production. With 93% of Canadian steel already emissions-free, Canada positioned itself as a premier supplier for Europe's upcoming carbon tariffs. Simultaneously, Canada imposed strict quotas and tariffs on non-FTA and Chinese steel, shielding its market from global dumping. A new Made in Canada mandate required all government infrastructure to use Canadian melted steel, a policy quickly adopted by key provinces. Ontario went further, mandating local steel for all new pipelines. These moves guaranteed a stable domestic market and attracted European buyers. Carney's strategy wasn't just defense, it was a pivot to global competitiveness. Canada turned crisis into an opportunity to future-proof its industry. For U.S. automakers, the tariffs were a gut punch. Detroit's supply chain, built on Canadian steel, collapsed overnight. Ford's River Rouge plant idled, and CEO Jim Farley warned Congress of $2.5 billion in extra costs for 2025. Each F-Series truck's steel cost jumped by $900, pushing up vehicle prices by $1,500, $2,000. The pain spread to cars built in Mexico, which also faced steep price hikes. Instead of protecting jobs, tariffs made American cars more expensive and less competitive. Automakers scrambled for alternative steel, but U.S. mills couldn't meet demand or match quality. Production bottlenecks and furloughs swept the Midwest. The just-in-time model that powered the industry for decades was shattered. The policy backfired, threatening paralysis in America's flagship sector. The lesson: modern manufacturing can't survive in isolation. The steel shock rippled far beyond Detroit. Texas oil drillers faced shortages of high-strength pipe as Canadian mills redirected exports to Europe and domestic projects. Pipeline operators like Enbridge resorted to salvaging old stock to keep projects alive. The supply chain's fragility was exposed, threatening energy independence and infrastructure. Politicians pleaded with Canada to lift the metal blockade, but Carney stood firm, offering only limited quotas. Canada, once a dependent supplier, now set its own terms. The U.S. lost leverage, and Canada gained new economic power. The chaos revealed that trade barriers cut both ways in an integrated economy. The U.S.-Canada dispute redrew the global steel map. Canada pivoted to Europe and Asia, leveraging its low-carbon advantage. By mid-2025, U.S.-bound Canadian steel exports dropped from 75% to 68%. European, Japanese, and Indian buyers rushed to sign long-term deals with Canadian mills. Canada's new trade controls blocked non-FTA steel, making it a sovereign trading hub. The U.S. found itself isolated from a critical supply of clean steel. Canada emerged as a key player in a new, environmentally conscious global network. The tariffs, meant to coerce, instead pushed Canada toward independence and global relevance. The human cost was immediate and profound. In Windsor, Ontario, layoffs and halted expansions hit families hard. 500,000 Canadian jobs tied to U.S. exports were suddenly at risk. Kristen Lawton, a fourth-generation Ford worker, described the plant as a powder keg of anxiety. Across the border, U.S. factories faced furloughs and production stops. Unions that once united workers on both sides now found themselves divided by politics. The tariffs fractured solidarity, replacing shared purpose with resentment. Economic statistics became personal, felt at kitchen tables and union halls. The policy left workers with fear, uncertainty, and broken trust. The 2045 steel crisis forced a reckoning in North American trade. Decades of integration were upended by unilateral action, but Canada's strategic pivot showed the power of targeted policy. The US gambit backfired, costs soared, industries faltered, and Canada forged new global ties. Rebuilding trust will require more than returning to the old status quo. Canada is now more independent, globally integrated, and assertive. The new reality, supply chain security and strategic autonomy, matter more than ever. Canada's investment in clean tech and diversified exports has built resilience. The future will be defined by cautious engagement, not blind integration. Geography makes the US and Canada neighbors, but not always partners. The aftershocks of the tariffs will shape the continent's destiny for years to come. Thanks for watching. Subscribe the channel for more updates.